Yes, it's hard to forecast, of course. There's especially trend when trend changes, all that stuff, it's hard. But just having the knowledge of how overvalued something is not hard because that's just in the data and the fundamentals are very simple.
If you're watching this on YouTube, make sure you smash that like button and click subscribe. For those of you listening on a podcast platform, be sure to subscribe on whatever platform that is and leave us a rating if you can. The more likes, ratings, and subscriptions that we get, the more we can spread the message and grow our community. So we also have a free Facebook group. It's called the Average Joe Finances Network. Check us out, join the group, join the community, ask questions, and become a part of the team. All of our other social media accounts are listed in our flow page, and we have them in the video or podcast description below. Hey, welcome back to the Average Joe Finances podcast. I'm your host, Mike Cavaggioni, and today's guest is Stefan Tsvetkov. So, Stefan, super excited to have you on the show. Thanks for joining me today.
Thanks for having me on, Mike. My pleasure.
Yeah, awesome. Hey, I'd like to start this off the same way I start every podcast episode off, and we want to know about you. So if you could share a little bit about yourself, share your background, how did you get started, especially in the real estate side? So how did this all work out for you?
Yeah, so myself, I'm a financial engineer originally. So I had a prior career in finance and I moved to financial engineer turned real estate investor. So I came to the US at 22, Eastern European originally. I went to grad school at Columbia in New York City. And then I worked like a typical route, working for about a decade in finance. In the recent few years, I've been a real estate and I am founder of a data analytics company called RealtyQuant.
Awesome. All right. Short and sweet, but it hits all the points of what we're looking for. Came to the US at the age of 22, worked for a decade as a financial engineer, and then you started your own company called RealtyQuant, right? I'd like to talk about that a little bit, about what RealtyQuant's all about and what you guys do. I know that a lot of it's very data driven. So if you could share with us, what is the whole thing behind RealtyQuant?
Yeah, so RealtyQuant is really data-driven real estate, data-driven quantitative real estate. So it's a set of methods, techniques for like real estate investing that primarily myself and built in-house for my own real estate investing. And so it's if you think of a hedge fund and they're investing in, they have their strategies, their investment strategy and so forth, and perhaps they're using data. So it's really building a ton of code, like Python codes and so forth, like in-house, to analyze properties, analyze market, and derive like the best investment decisions, find the best markets in the US, find undervalued residential, commercial, multifamily properties, and so forth. So it's really like an analytical, data-driven approach to that. So we publish market valuations data for every county in the US. So what that means is just basically which markets are over, under, fairly valued. So that's like fundamental analysis. That's one thing that is out there for people to see at RealtyQuant.com. So that's available for 2,700 US counties. So we can look up, let's say, whichever county in Florida or Texas or other place, if it's overvalued, undervalued, based on fundamental historic analysis. And that's actually something that's been having very high predictiveness after the global financial crisis, as well as the prior two recessions. So it's back studied against 3 recessions, actually, as to how well it's predicting overvaluation.
Yeah.
And that's one thing. And on the property side is just various other methods of machine learning. They do like financial modeling for based on rental listings data for basically every commercial multifamily in the country. So that's a product that's coming up for RealtyQuant. Some textual property intelligence, like deriving kind of an automated underwriting module, deriving like insights from, okay, reading property descriptions. And if you have thousands to read, can you derive like what's the condition of those properties based on what is stated there, or other parameters. So natural language processing, textual property intelligence. Those are like different things like in-house. We have our own AVM an AVM, like just for your audience, like an automated valuation model is basically what Zio's estimate is. So I have like my own kind of relatively simple AVM that I use in-house to discover like some pricing efficiency, more from my like residential investing primarily, but I've been more focused on commercial recently in the Midwest. So
yeah, no, that's great. So you're basically pulling all this data, right? All this real estate data and putting it all together in this one spot that's going to tell you if an area is overvalued or undervalued. Is that like kind of the gist of it?
that's on the market side. It's just pulling all governmental data for income, population, housing supply, and just deriving like a statistically valid estimate based on the prior recessions of if the market is over by what percent. Is 20% overvalued? Is it 10% undervalued? And that's on the market side. That's the market side. And then on the property side, it's just like getting more property analytics, like doing automated underwriting for properties, basically,
Okay.
like pulling thousands of listings and underwriting them. On the commercial side as well, it's a little bit challenging, but like for off-market commercial, it's very doable based on, in a preliminary sense, based on the rental listings data. So that's another thing working on. So it's just like a lot of different like data products and analytics to help on one side myself as in my own investment firm, and on the other side, other investors as well.
Okay. Yeah, that's fair. So actually, I want to talk about that a little bit too, about the actual whole data-driven investing in general. So what is data-driven real estate investing?
It's a great question. Yeah, data-driven real estate investing, it's really a mindset, I would say. It's just kind of like having the mindset that, okay, you can automate a lot of the stuff that you do, analyze properties and markets at scale, as opposed to what is the more typical notion in real estate, that real estate is hyper local. Now, for something that's hyper local, there's data-driven techniques, let's say like neighborhood appreciation predictions, like hyper local thing. But generally, like if you think of you investing in your own backyard, so to say, like in your own neighborhood, technically that's kind of the other comparison for something that's, well, not data-driven, because you're not really analyzing markets, you're not really analyzing perhaps even properties so much at scale or across multiple strategies. And here it's really, okay, you're going to pull out like thousands and thousands of market or on market, like various data points, and try to find like properties this way. And perhaps you're going to underwrite them on like 5 different strategies. It's not going to be just one. So it's a more scalable approach.
Okay. Now that's how you would do it with it being data driven. But what are some, I guess, common investing practices that are not data driven?
Oh, that's a great question. Yes. So that would be, if we take, for example, just like if we take commercial investors, how they pick their markets, in my opinion, let's say you have, okay, they're going to pick like job growth and population growth and income growth. That appears data driven in a way because it's using some kind of data, but in a sense, often it's, okay, let's pick Atlanta, Georgia and a few other markets and see if they have good fundamentals, generally speaking, above some thresholds perhaps. So that's not, let's say, so data driven. Like for me, I really have it for the whole country, and I know how it's evolving, I know how it's developing. I have at least in the data and intuition about every single market.
So it's not as in depth.
It's not as in depth, and it's also not so statistically valid. So if, for example, if population is growing in a place, it doesn't mean prices are necessarily going to increase. Typically prices are around like 40% correlated with appreciation, but not more. And so that's something. So now if you have prices and you have income, then okay, then that's very relevant and very predictive, but not always. And then there's more. So for instance, one study I did at RealtyQuant was, okay, let's take fundamentals. If you think of what a multifamily syndicator, investment manager, investor does. So they take those fundamentals, again, like income, population growth, let's say job growth and so forth. And let's take those fundamentals, forecast the fundamentals, and then forecast the prices of those fundamentals. And then on the contrary, if we just forecasted prices alone based on the historical prices. And so the second approach gave like a 5 times smaller error. So that's very interesting. And that was like, for instance, like in forecasting prices, very high level across different states in 2018, 2019, when the trend was very consistent. So 2018, 2019, like the error was like 1.4% in forecasting those prices. It was very easy to forecast prices, but it's that easy if you go on using the price data alone. It's a little bit counterintuitive. But if you go on saying, okay, because there's population, because there's those other factors, and then these are going to be the prices, you inherently are committing a 5 times bigger error. So that's another kind of example. So it's not really so data driven just to take 3 data points and just say, okay, that's a good market because it has this population growth, this and that. So those reports themselves, they may be derived and be data-driven themselves. But if I read it, it's not going to be data-driven to me as I read it. I'm not going to internalize that information, perhaps, unless I go in like really big depth and I try to experience it in some way. But typically, it's not going to happen. And so typically, it's even like reading those summary reports, if you will. So you need to interact with the data, or somebody on your team needs to interact very closely with it and be building intuition and feeling about it. And so that's like another thing. So it's really a mindset. But again, if you look on the property side, it's just very much deals with automation and automated underwriting and just trying to make your work easier and scale. So that's the approach there.
All right. So what would you say are some of the differences then between if a commercial real estate investor is going out there and they're pulling that data, the fundamentals that you were just talking about, versus what like RealtyQuant would pull? Like, where's that difference or the threshold of a difference in that data?
Yes. So for example, so like I mentioned, so let's say, for example, they would go to they would look at 3-4 markets. They typically, I would say, think, or 5 or something like that. And they would just look at those, let's say, 3 numbers for those markets. They would look at, again, like job growth, population, and so forth.
Yeah, like you said, it was very hyper local, right?
It's right. What I would do is I would kind of take the whole country and try to forecast. First of all, it's broader, but second of all, it's also the forecasting methodology is different, because now the forecasting methodology is actually statistical rather than just assuming that if those things kept going, they're going to go well in the future. But it's not really there isn't a forecasting method there. And so that's like that's one difference. But then how on the property side, for instance, they would use like Yardi matrix or prospect now data feeds. It's not yet a product there, but it's been in the works. Yeah, perhaps this month coming out actually. Is like financial modeling on top of off-market commercial multifamily data. So if you go like prospect now or Yardi matrix, or you have your inventory, perhaps there's signals for motivated sellers, but there is no financial insight on that off-market data. So what RealtyQuant does, or what I do, how I would search for those deals, I actually would pick commercial multifamily in many different counties. I don't focus on just one, let's say a few counties, and try to pick the best ones in those counties. And those best ones get identified by proxying based on rental listings data. Because if you think of rental listings data, you have what the rent levels are there. You have some of what pet fees, administrative fees they're charging. You have even a sense of perhaps if they're billing utilities to their tenants. So one can model this. So you can get a preliminary glimpse of the income expense sheet of commercial multifamily. And I did a lecture for my own webinar where I was showing, a sample case of, I'm doing this for 32,000 commercial properties that have 100 units, 200 units, and so forth. So this is like the difference. It's just a more scaled approach. It's also typically not so necessary for many investors, since, again, you're just in a single market and maybe are vertically integrated, and there are all kinds of reasons to be focused within that. But if you do go the other route and you want to be more agnostic and be able, to discover markets and opportunities in different places, then you need something like RealtyQuant.
Yeah, there's a lot of people out there that talk about why you should invest in different markets. Because if you're all in the same spot, if that market tanks, you're done for. If it's putting all your eggs in one basket, right? It's the same thing that you talk about with diversifying your stock portfolio, right? You want to have it diversified. You don't want to be all in on one thing, because when that one thing fails, you're toast. That's a very good point. And I think based on what you're saying, one of the big differences, besides just being like hyper local, like most people are when they start looking at their deals, right? This gives you that broader picture for you to really you have a lot more to chew on and figure out, maybe I don't want to go here because I'm seeing some better metrics over here. And then you could start to focus, maybe get a little more hyper local based on that, based off the data that you found on that specific area. So no, that's pretty fantastic.
And you're not basing it off the names of those markets. Let's say if you like the other approach, just some markets, they're just already investors have identified, they're good markets or something like that. And here it's like pretty agnostic. It's just, I don't care what the name of that market is. So.
Yeah, no, that's a great point. Now,
and there's valuation. So I'm sorry, Mike, just to interrupt. The other question that there's also valuation, because the other thing is now in real estate, we're primarily concerned with the property side. And I know investors do a really amazing job with finding like undervalued properties, if you think about it, right? So there's so many investors who do so well. Okay, they find like something that has a great value, that has a discount perhaps too, and so forth. And this is practiced really well. So if you think of something like Warren Buffett type investing and finding undervalued stuff, then okay, on the property side, it's done really well. But on the market side, it's not. And that's one thing I've been like going on like podcasts like this one and kind of talking to people, okay, you can do the same thing on the market side in real estate. It's hard to do it in finance. I come from, again, I was used to trade like interest rate and equity derivatives in finance. And in finance, it's hard. Even now, like I'm looking at so many studies, like is the market overvalued and so forth. There's so many metrics. There isn't a clear, they're kind of way off relative to each other. There isn't a clarity as to what exact percentage the market is over or not overvalued. And in real estate, fundamental analysis works because that's like taking something, a very simple subsector in the stock market, let's say utilities companies. It's not hard for somebody, like for a value investor there, to know what they should be worth, generally speaking. And it's not hard to know what real estate market should work, because real estate markets, they're driven by income, population, and housing supply, and pretty much that's it. And so if you track those, you can know it with a very, and so I did the study actually just to share like about GFC, like global financial crisis. And okay, and so what was the correlation at the state level of what percent states, just generally states were overvalued and how much they declined after that. So if you take, let's say like California, Arizona, Florida, and Nevada were the states that like heavily crushed 40-50%. They were 40-50% overvalued, by the way, pretty much. And so this correlation, if you take it across all states, was 85% correlation, very high. That's forecasting the future. Those are the kinds that happened over 4 years' time. And real estate is not so stochastic. It's not so random. It's not like something where you just cannot know anything about it. And so similarly in forecasting, like people tend to think, okay, you don't know where prices are going to go. And I'm not a fan of forecasting per se so much. I do it because it's still better than not doing it. But I'm not a huge fan, let's say, emotionally. But then if we take even forecasting, so there is a very big, I did momentum studies in real estate. So there's very high momentum or autocorrelation. And so it ends up that just if you take something like price growth this year is correlated with price growth last year to 77%. It's very high. So it's at some point the trend reverses and then it's going to break. But generally speaking, there is lots of momentum, and even that gives like this sort of like a weak form inefficiency, they call it in finance. This kind of thing becomes okay. You can somewhat even forecast prices, and that's where in 2018, I think I mentioned 2019, that was working really well. And then okay, later, let's say 2021, with inflation, kind of the trend broke or changed. But yeah, so real estate is very fundamental. I've been trying to attract people's attention because I don't think it's so important if they forecast prices versus what they're doing now. Okay, they are committing a bigger error by only using all those fundamentals and not doing more detailed statistically valid forecasting. They are committing. In fact, in that study that I mentioned, like the error is like 5 times bigger. But still, they catch the correct markets more or less. Everybody knows what the good markets have been. Everyone knows it's in Florida, in Texas, the western states, like to the west and south, this market cycle. But what is extremely not practiced, and I've been getting in few like of the private equity funds and syndicators to join a board actually, is downside risk, it's valuation. It's so easy to know what the valuation is, and yet nobody does. And I don't know why, because there's big firms that do it. Moody's Analytics does it. Bloomberg Economics does it. There's the data that we publish as well. But it's not common among like investors, and so they would be constantly guessing. They would be in that market can be 50% overvalued, or it can be 0% overvalued, and they have no idea about it. They just will think. I live in, let's say I've invested in New Jersey. It's not a good choice, but let's say historically, as a residential investor years ago. And so people in New Jersey, they would say, oh, it's very overvalued. And that's not true. Like to anybody who actually estimates, looks at that, would realize, okay, so it's actually a very undesired state, this market cycle, for all its valid reasons that it's undesired. And it's actually undervalued, in fact. It's not expensive at all because nobody wants it. And if you go to Idaho and Arizona and Florida, and those are the markets that are expensive, and we can get into some exact percentages I'm not sure if your audience wants to know, like cities and so forth, is for what shows in the data is overvalued or undervalued.
Yeah, those are the hot spots right now, right? That's what's hot in the market, and that's where everybody's putting their money. And when you do, that's what causes some of this. It's like the gold rush. Everybody running to California with shovels to get gold. What you said earlier, like about the market being overvalued, like that is such a buzzword right now when you say overvalued, right? Because it grabs attention, but at the same time, the data and the metrics that people are looking at to come to this conclusion that it's overvalued sometimes is so broad that you really can't pinpoint where it's overvalued. And I think that's like what you were talking about with that. And then you look at different markets, right? Like you used New Jersey as an example, right? Nobody's buying real estate investment properties in New Jersey. And why is that? It's not like a landlord friendly area, right? And they look at the properties and they say, oh, the properties are overvalued, because pretty much all of the Northeast, you look at that and you're like, oh, it's all way overpriced. But when you look at what the median household price is out there, it's pretty normal. So it's same thing out here in Hawaii too. We say the same thing. Oh, it's so expensive to live here in Hawaii because the median household price is over $1 million. And sure, it is. And of course, the policies here also are not very landlord friendly. There's all these other metrics that come into play when you think about where people are putting their money when they buy real estate. That's the stuff that people need to be thinking about when they want to jump into the market. Is there opportunity in areas like that? Sure. But is the risk higher? Yes. So those are things that you have to all put together and make sure that it's something you're comfortable doing. I want to like dive into that a little bit because so you created RealtyQuant, right, as something for yourself at the beginning, right? This was something that you wanted to do for yourself as an investor, and even now it's something that you share with everyone else. So I just want to I kind of want to jump into that a little bit, because I feel like, what are some of the personal things that you were looking for that you felt would help other people, and that's how you came to the conclusion of creating this?
Absolutely, yeah. No, really, everything at RealtyQuant is really the stuff that the tools that I essentially built for myself. That is the truth, and that's a goal. And so, if we take again market valuation, the reason for like market valuations, like you said, like many people, that it's a buzzword. I actually don't like it because it creates this kind of negativity a bit in the market and creates like some kind of a bit like fear mongering. I saw like people on LinkedIn kind of a little bit getting too heavy with recession word and like all that stuff.
It's clickbait. It's to get you to
exactly, and
to get you to, it's an attention grabber, right? It's to get you to watch their video or listen.
So I'm actually not a fan of it like that, because to me it's like something like market valuation over under average. I track it already for 2 years consistently, quarterly, for every geography. It's not something that is meant to scare people off or whatever. It's just like to be aware of, okay, where to start. So if you are having capital in X market, perhaps you start rebalancing your portfolio. Perhaps you start moving to other markets. And it's not because even if there was a recession, there's not going to be a ton of opportunities in real estate, which every investor knows that there will be. But again, it makes a difference where you are, because if you look at, for instance, I'm sure perhaps you've had Vinny Chopra here, right, at this podcast, or I'm not sure. And let's say Vinny Chopra, he was at my webinar and he was saying he did like his first syndication in 2008. And I remember, and he had like very good return on that particular syndication, but it was, the entry point was in 2008. But the reason is, okay, knowing the data myself back then, he invested in an undervalued county in the then undervalued state of Texas. Because by the way, Texas at the peak of 2008 was undervalued 5%. And that was not the case if whoever invested in Florida at the time and lost all their net worth. And so it's like very important. And so that's like more like the question, but it's not like to scare people off. And it's also another thing. It's not also if something is overvalued, because you're in Hawaii. Mike, let me give an example with Hawaii.
Yeah.
Hawaii, there was a recession in 1990. Okay, it's like an old time thing. Just a study I did. A recession in 1990. Hawaii, 1990 US real estate, very undervalued. 39 states are undervalued, many of them deeply undervalued. If you take the whole US index, K-SHIU or whatever you want, the price is basically flat after the recession. There is a recession, prices stay the same. It's like the thing you've heard, like in recessions, real estate doesn't always decline. It's true, but the reason is it wasn't often overvalued as well. And so at the time it was undervalued, 0% decline. But there were 8 states which were overvalued, more than 20% overvalued, and they all declined. And so Hawaii was an example, and Hawaii was 48% in my study after 1990 overvalued. And what happened then? That there's very strong, relatively strong like growth or recovery afterwards, and there's no like broad-based real estate issue to actually for real estate to crash, and broadly real estate stays the same. Collection of markets in Hawaii, the state of Hawaii. So that collection of markets is 48% overall, and the prices declined only 14%. It's not like they declined as much as the overvaluation, but this is a secondary question if a correction happens or not, because those prices, they declined, they were 14% lower in 1998, 8 years later. So they were stagnant and slightly declining for 8 years. And so that is really the risk. I think now that I've been trying to communicate to some people who invest in Idaho, it's not because they have a forecast, because Idaho is like around 50% over, but it's the only one. So I'm not in any way like making like some kind of statements of it being overvalued, let's say that they're like negative.
The world's coming to an end.
2021 quarter one, US real estate was fairly valued, right around 0%. It's quite impressive. There were few markets that were slightly overvalued. Idaho was at around 25% at the time. But again, like that was the case. And even now it's not. If you take broad US real estate, do you know where it's now in my data? Plus 13%. That's it. It's not like it's a huge bubble. But again, the highest it ever was GFC at plus 20% in this data source. So that's the biggest bubble is plus 20% if you take the whole US, because like many places they undervalued and so on and so forth. And so now it's at plus 13 in my study versus plus 20 in GFC. And then basically other recessions being at right around zero or negative or undervalued. So there is an overvaluation that is there, but that overvaluation is in few places, and yeah, Idaho is very pronounced. And so Idaho came, I think, like plus 54% or something like that. It's like kind of extreme. And I speak to some investors that I know, like personally in Idaho, and I think the question is, it's not like our price is going to crash or correct. Even if they don't, something that is so much overvalued, the question is, what is going to be its relative performance over the next decade? And chances are, if we take the comparison to Hawaii at a similar valuation in 1990, that the very best price performer of this market cycle, the state of Idaho, would underperform that. Because Hawaii was also the very best price performer then. And that is really the dynamic. And so it's really so that's the real thing. Now, depending on how strong economic recovery is, and first of all, we don't even know if there's going to be a recession yet or when it's going to be and so forth. But let's say, assuming there was, if the economic recovery is very strong, then the correction ends up smaller. If the economic recovery is very weak, then the correction ends up bigger, like GFC, like global financial crisis. But then either way, sooner or later, that overvaluation resolves, always. Like GFC, for instance, there were like 2,700 counties that I have in my data. So how many of them didn't resolve? It was less than 1%, perhaps, or something. It's 99 point something percent did resolve. And so that's like the importance of, you don't need to time the market. If you know this, you need to just be very, just understanding that if you buy in a very overvalued time, because you have to keep in mind, another thing is, how you mentioned, okay, those are the hot markets. But then if we go back to 2020 beginning, now Utah is a hot market too, right? Let's say generally Western states. Utah was fairly valued at the time. And it was already hot, it had already appreciated a lot, and it was still fairly valued. I believe the county that contains Denver being a top performing city, this market cycle was also fairly valued. So it depends. Sometimes, if we're a little earlier in the cycle, it could be that extremely booming markets are still fairly or even undervalued. You just have to track it and enter at the right time. But it just happens to be that, okay, with inflation, it's like all investors, they say, oh, inflation is amazing. For real estate, it's just gonna grow real estate and so forth. Part of what that led to is overvaluation. And so since the second, and it came out actually at my own, I have a YouTube channel, and it came out at my own YouTube channel, like the second and and mentioned basically second and third quarter of 2021 is when US real estate started sort of entering a more extreme overvaluation regime, where before it was fairly valued. And so it started a little bit of a bubble regime, because a very sharp change from something that was very consistent for 4 years at least, suddenly jumping. So why is it happening? It's because of inflation and many kind of investor demand around that. But yes, and so those are like some consideration. And yeah, so generally, if we speak like very high level, so Western states are overvalued in this data, kind of more overvalued, and then Southern states a bit less, let's say just overvalued, and then Midwest is fairly valued, and then Northeast is even undervalued. And it's not a good predictor of appreciation on the upside if something is undervalued, because typically it's most often it's weak markets already at this point of the cycle. So they're weak, they're not going to appreciate that they're undervalued, but they likely will be protected in a recession, at least from a valuation standpoint, because that's in GFC, there were around 10 states that were undervalued at the time. Their decline was median, I think 4%. And 4% was actually the, I think, average income decline after GFC. So kind of if you look at, let's say, if you take in a more simplified sense, just prices and incomes, and that drives valuation. Now there's perhaps more, but then we can say that in normalized terms, that's in price to income terms, they stay the same, those states. So you have the biggest decline in the biggest kind of collapse of real estate in the US, and the undervalued states, they stay the same. So it's like quite impressive. And so that's a benefit for some of the people investing for yield now, because I spoke like this private equity fund, and they were saying, okay, we are investing in secondary and tertiary markets in the Midwest because, okay, there is concern with some of the overheatedness in other places, and assuming we enter a recession and so forth. And that's the benefit of seeking like higher cap rates or seeking yield as well in this case, because it could outperform if there was a recession. If there isn't a recession, then not. Then the overvalued markets would outperform until then. But at some point, if something is very overvalued, if something is just 20% overvalued, okay, that's not a big deal. But if something is 50% overvalued, then perhaps it's just like the surprise, I think, that's going to be there for investors, in my opinion, from what I've seen historically in the data, is that is actually going to become a weak performing market. And that's something they don't realize. That's the example of why at that time. And because valuations, they mean revert, and they just, if you look at their history, if something was overvalued, it always goes to zero at the end. It always goes to zero. It could have been 100+% overvalued. It always goes to zero.
Yeah, those are all great points. And there's a lot to unpack here, because you're talking about pretty much like what makes the actual real estate market overvalued. So you touched on that. And then you're also talking about what are the metrics and predictors that you're looking at to mitigate that risk, right? Now, you also talked about like which areas are overvalued right now, but I'm more curious as to where you're seeing like the best performing markets, like for people that are wanting to get into it and start investing. Like where are those spots? Where are those hot spots for them?
Yeah, this is a great question, because it's the most difficult time for this. It's not straight thing to give, because think about it. It's like the best performing ones are the ones that are going and becoming more and more overvalued. Best performing is investing in Phoenix, Arizona, or in Boise, Idaho.
See, we're revealing all the secrets here.
Or no, it's not a secret.
It's just the data.
No, I'm just saying. So that would be the best performing, would be like the ones that are already overvalued, and they continue because of momentum. They continue getting more and more overheated and more overvalued. But the tricky part is really, I think your question is, okay, how do you forecast what's going to be the performance from now into the future? And that's a hard question, because I don't know if recession triggers or not. If I do a model, let's say recession triggered, okay, I can try to forecast. Now I have valuation. I can forecast the fundamentals in different markets and net them out. And because we have a recession trigger, I can perhaps say that, okay, that we are gonna get like that a bit less strong performance in the recession based on those fundamentals and something like that, and try to model it out. Now, at this time, there's no point of looking at valuation until a recession triggers. There is a lot of point of looking at valuation, but there's no point for appreciation forecasting. And there isn't even point of looking at the fundamentals so much, because what you have to do is take the trend of the prices and forecast that and write that, because that's like what's actually happening, because there's momentum. So it depends if the recession triggers. If recession doesn't trigger at some point a year from now and so forth, for this 1 year or 2 years or more, whichever period, it's going to be that the same markets that now have shown the highest appreciation this cycle are going to continue to be the best ones. So it's going to be markets in Idaho, in Arizona, in Utah, in Nevada, in Florida, and Texas.
So you're
so
saying
forth.
it's
I
good
can't have an
to
obvious
stick
answer.
with those markets?
No,
Or
I don't think so.
okay.
I think what is good though, no, so that again, those are the ones they're gonna appreciate until recession hits.
Okay.
When that happens,
They still got
they're
that
gonna be the
momentum going.
worst ones. Yeah. As that happens, they're gonna be the worst ones to be in. And so where if one takes, okay, just because I don't know if a recession triggers or not. So if the best place, in my opinion, now is to invest in the Midwest and places like that, to invest for yield and to invest a boring thing, but essentially in undervalued markets or fairly valued markets. And so that's what I do. So I search for now commercial multifamily in the Midwest because I don't want to invest in Florida that I think came out at, what is it, 27% overvalued, the state of Florida. But that's a taste. That's my own like risk preference. It's because again, I could have said I'm going to invest in 27% overvalued Florida because prices are going to boom the most this 1 year in Florida. And that's a very valid strategy. But again, if recession triggers, then this is your best statistical predictor. Underperform, let's say not necessarily declines, because it could be that don't correct the price, but definitely underperformance after this.
Yeah, it can give you a good idea of what's to come if that recession hits, right?
Very much. It depends, again, like how much of a correction scenario it is. But if you have a GFC correction scenario, then pretty much what the valuations were in different, again, states, that's how much they declined on a very high level, to an 85% correlation. But that's not always the case. Like I mentioned before, it could be a smaller decline because the recovery is very quick, very strong, like incomes and everything's performing very well after the recession at some point. So it can vary. But even if that's the case, that market has a lot to overcome, has all that overvaluation to overcome. And so it becomes more stagnant. And so that's, for instance, in Hawaii, think of investing in Hawaii in 1990. That was the best performing, highest price appreciation anywhere in the US. You invest in Hawaii in 1990, fast forward 8 years and 1 quarter, and prices are 14% lower. So that's not a good time to invest. It's just because, okay, that was the best. And then if one was talking to investors, they were saying that's the best market. That's the thing that I hear about Idaho now. Okay, it's extremely booming. Fundamentals are so strong. I know the fundamentals are strong. That's reflected in the prices. Everybody knows that. The question is where prices relative to those fundamentals. And if they're 50% higher, then that's not a good market to invest. And so it's probably going to underperform next market cycle and very high likelihood. And it's very hard, much harder for like other places that are just 20% overvalued to get. Different things can happen there, different scenarios. Perhaps they recover really strong and so forth. But yes, so my personal opinion is people should start rebalancing from Western and Southern markets to the Midwest and places like that, or other Southern markets that are just not overvalued, like less desired Southern states. And that's just my guess, but this is a risk preference. Everybody can have their own risk preference and choose.
Yeah, it's just good to diversify and not have all your eggs in one basket, because if you drop that basket and they all crack, then you're done.
Yeah.
So
they're investors who are only in Phoenix, right? They're investors who have their whole huge multifamily portfolio, Phoenix alone.
Yeah, I know when we were talking before we hit record, and I was telling you, I'm in 3 different markets right now. So, and I always thought it was good to just diversify, because whether you're in the stock market or in real estate, it's important to be in different areas and different markets, because each real estate market is its own entity. It is its own market. Just because you see a huge decline somewhere doesn't mean that every market in the US is going to decline the same. If you look back to 2008, 2009 timeframe, you know, where there were some places that dropped 40 to 60%. Out here in Hawaii, it dropped 10%. So it just depends on what market you're in and what kind of impact it's going to have when it does go kaboom. If it does go kaboom, we'll see. There's a lot of factors that lead into that. But again, it's very hard to predict these kind of things, which is, if you could predict these things, I think everybody would be rich.
But I think it's hard to, because it's hard to predict the timing. And it's also hard to predict the exact magnitude of a correction. But in terms of, I think those are not even the most important questions. For me, let's say as an investor, I don't know, as a professional kind of investor coming from finance, valuation, I don't even look at the prices anymore. I just look at like valuation, like this discussion, because to me, it's just, it doesn't matter if something is 50% over, declines only 15% after a recession. It does matter, but not super much, because it's still going to underperform by that decline of 15% is going to be dragging for too many years, perhaps, or something like that. And it's whether you have sharper correction or not. It's an important question, but a secondary question to me. And so yes and no. Yes, it's hard to forecast, of course. There's especially when trend changes, all that stuff, it's hard. But just having the knowledge of how overvalued something is not hard, because that's just in the data, and the fundamentals are very simple. It's income, population, housing supply, and there's nothing else, because people say sometimes, okay, real estate now is going to be different or something like that. Okay, different from GFC, if you take, they had all that financial structuring of products and excessive lending and all that stuff. Doesn't matter. GFC valuations, they were consistent with, it was like 1990. It was overvalued on very simple fundamental terms that were measurable. And there were people who were looking at it at the time. There was Ingo Windsor, is somebody, I think Neil Bauer uses some of his stuff. Ingo Windsor out in Massachusetts. So he was out on CNN and like sharing like some stuff about the California and Florida markets and so forth. So yes and no, it's hard to forecast the exact price movements, but to just know if something was overvalued is not hard. And it's something that is accessible in fact. And yeah.
Yeah, no, that's a lot to unpack and just a lot of good golden nuggets there, Stefan. Definitely. So I kind of want to transition this now to get more back to you as a person. Sure. As we go into something that we call the final round, I want to ask you some more personal questions about you, and this kind of gives our listeners a good understanding of how you got to where you are today. Because when you look at, you came to the US at 22, you went to school and you went to Columbia and started working in finance, and just you started building this massive undertaking in real estate investing, especially with this program that you built, or this website that you built. It's a testament to the hard work that you've put in. And it goes back to something that you mentioned earlier, was that mindset, right? I want to touch on all of that in these questions. So if you're ready, we'll go ahead and start the final round.
Sure. Yes.
Okay. Awesome. Hey, so Stefan, the first question is, and this is a big one, it's a doozy, all right? What's the biggest mistake you've ever made?
Biggest mistake, personally, spending as much as 10 years as in employment as opposed to entrepreneurship, where employment is sort of income optimizing instead of equity optimizing, and a waste of time for me personally. And so that's the biggest mistake. I wish I exited earlier and entered into entrepreneurship.
Okay. Yeah, that's fair. All right. This kind of ties into the next question, right? Because I'm sure you have a lot of lessons learned from that. What is something that you've learned that you wish you knew when you first started?
Yes. So when I first started, let's say when I was working my W-2 job, and let's say I would invest, and I look at like things probably like stocks or cryptocurrency or other stuff. And I think what I wish I had learned is how to do private equity investing like earlier, be it in real estate or in other. I honestly don't care if people invest in real estate and improve, let's say commercial real estate, and improve the profitability of those buildings. Or if they had that expertise, they invest in technology companies or data companies or whichever private companies, laundromats if they wish, whatever they wish. But private equity investing where you have control, and you also labor, respectively, with control comes labor and responsibility, but where you have control and where you yourself affect the valuation of that business. And that's like something that I wish I got into much earlier, instead of just basically not having high quality investment options in just the stock market and that.
Okay, yeah, that's fair. It's definitely something that you can take with you into the future as you go on, and utilize that as you can look back and be like, okay, I know where I messed up on this. I got to do better. That's awesome. All right, the next question is, do you have any tips or tricks that you would recommend to someone that is just getting started today?
Great question. So tips or tricks to someone that is just getting started?
Use RealtyQuant.
Well, yeah, I guess RealtyQuant.com/analytics. They can look up some data there, and some can read our blog as well. So those would be like the best place for tips. Yeah, thanks.
See, there you go. Awesome. All right. And so for you personally, do you have a favorite business, investing, or real estate related book or podcast, or both?
Great question. No, not like a book. I liked a finance book called When Genius Failed, like about a hedge fund, like the Russian debt crisis. So that's I can state as a book that I like. And I like the Best Ever Real Estate Show, like few other podcasts. I'm not a huge consumer of, to be honest, of books and in the real estate space and in that sense.
Okay, no, that's fair. That's fair. You got a good book recommendation in there too, and some good podcasts that you enjoy. That's awesome. Now, that's it for the final round, Stefan, but I do have one more question for you. And it's probably the most important question of all. And because people will listen to this episode and they're like, man, this guy knows what he's talking about, and he's doing the data, he's doing the research, he's getting all the data, he's got a great system put in place. So they're like, I want to learn more about Stefan Tsvetkov, right? Where can I find that information about him? So do you have a website, social media, anything like that you could share with us?
Yeah, absolutely. Yes, so RealtyQuant.com. So our data is there. Also, I will be starting like a data-driven investing course. It's gonna have some programming in there, but I'm gonna do also no programming version, a lighter version as well for investors. So if they want to learn from me about like how to do like data-driven investing, that's something that I've been working on as well. But it's going to be RealtyQuant.com. I also have a YouTube channel, Finance Meets Real Estate.
All right, fantastic. Hey, we'll have those links in the show notes to make it easy for everybody. You can just copy and paste or click away and go check out Stefan and see what he's doing. Go check out his website, go check out his YouTube channel, because if you liked what you heard here, you're going to have all of that and more when you go check out his stuff. Definitely appreciate it. And Stefan, hey, I really appreciate you taking the time to join me today on the show.
I appreciate it, man. Thanks.
All right, hey, we're out of here, and aloha from Hawaii. Thank you for making it to the end of this episode. Greatly appreciate you being here with me today on the Average Joe Finances podcast. If you haven't done so yet, make this the episode that you go leave us a 5-star rating or subscribe to our YouTube channel. The Average Joe Finances podcast is for informational and entertainment purposes only. Have an outstanding day.